Our next guest says that Canadians have finally arrived at the proverbial rainy day. For his take on the future of the Canadian dollar and how Canadians are investing, we turn to Adam Button. He's a currency analyst at ForexLive. What do you exactly mean by the rainy day statement? Are you referring to the government's ability to dial up fiscal spending?
Number one, and number two is the consumer. So we know the Canadian dollar is in a rough patch. We know this is the end of the commodity super cycle. We've had 15 years of sunny days. Now, the market is pricing the Canadian dollar over the last month, something like a recession, probably problems in housing, mass layoffs, especially in the commodity sector. But the question the market's having now is because it hasn't appeared in the data. These problems haven't appeared yet in the data. So if we look and we think about the Canadian consumer over the past 15 years, is it over-leveraged? Have they saved enough? And can they carry the Canadian economy through this next stretch? We're going to find out with retail sales in large part later. At the same time, the government has that ability. The Canadian government has largely saved. It has some ability to stimulate the economy. We see the same problems hitting Brazil, Mexico. They're having to cut spending, government spending at the same time. And so then you have a full-blown crisis that feeds on itself, whereas Canada has the ability to spend.
And that's because our debt to GDP ratio is at a spot where the government can comfortably dial up fiscal spending. Would you agree?
Absolutely. This is the time that Canada has to spend money. And the Canadian government is slowly, politically been moving towards opening that up. And I think at this point, they have really no qualms about spending, almost in unlimited amounts to keep the economy growing.
How concerning should it be if retail sales for December come in at that contraction of almost a full percentage point that we're expecting?
That's where the market is right now. We've had a good bounce in the Canadian dollar. And the thinking was, well, the trouble is coming. But when you're betting against the Canadian dollar, you say, well, okay, we're 10 cents into the money here now betting against it. But the data hasn't started to show any problems yet. So this could be the tipping point. You're not going to make up your mind on any single data point, but retail sales is an extraordinarily important one. Expectations are low, so there is some scope to beat it, and that could help out the Canadian dollar.
What people will be really interested in you giving us is your outlook on the Canadian dollar. We just saw the rally that has taken place since January the 20th, when on January 20th, the loonie touched 68.5 cents. It's now significantly higher. Where will it be a year from now?
I believe the Canadian consumer is conservative. You look back at the U.S. housing crisis 5-6 years ago, people had credit card debt in mass, refinanced homes, and Canadian consumers have put money aside and can weather it maybe a little bit better than the market assumes. However, Canadian dollar is a slave to oil, and oil is going down. We're at the point now in oil where it's bounced and the bottom pickers are coming in. But a bear market doesn't end till everybody gets cleared out. And they're going to get cleared out in the next round, and we're down into the low 20s or even into the teens in oil. And that unfortunately, the Canadian dollar is going down.
You think the oil could go as low as $18, $19 per barrel?
Absolutely. The supply, we're running out of places to put oil. And the refiners now have the opportunity to squeeze the producers at costs that are well below the cost of producing oil, and it's coming.
What has driven that albeit a very short-term rally from January 20th today? Why has the Canadian dollar strengthened over that period of time?
The Bank of Canada has been optimistic. The Canadian government has stepped up to the plate and said it will spend money. Canadian data has been okay, especially if we look at December, the trade numbers were strong. So you had this idea that manufacturers were going to carry the weight. Now I think it's a 1-month blip probably in the data. New orders have been weak. So you had a little bit of a rethink and a little bit of profit taking. But in the grand scope of the Canadian dollar rally, it was a fairly standard bounce.
If markets are correct and the U.S. Fed will not proceed as fast as the Fed has signaled on interest rates, how much of a positive is that for the Canadian dollar?
Right, that's the other side of the equation. The U.S., when we were talking about a 68-cent Canadian dollar, the U.S. economy looked like it was doing fairly well. The Fed was talking about hiking. And that's off the table now. And the U.S. market has adjusted very quickly, and you would almost have expected the Canadian dollar to bounce a little bit more because the Fed or the market has taken all the Fed rate hikes off the table. So there's some scope for the U.S. dollar to do a little bit better here, and that will weigh on the Canadian dollar side.
What's the relationship, if any, between big fiscal spending by governments, the willingness of governments to run deficits, and the domestic currency? In this case, the fiscal spending we expect from Ottawa and our currency.
See, any government can spend money and create a little bit of growth. The market generally struggles to understand how the spending will translate into growth because you see the spending projects, the numbers are always inflated, and they're spin. But it can certainly generate growth, maybe a half percentage point of growth. But if the government's wise, it will invest in longer term projects, and those might take a little bit longer to come to market. So that, or to start to filter through to the economy. So that's going to be the balancing act. But certainly the government has the ability to stimulate the economy.
The OECD said yesterday, and Michael Ingram, my guest from London just a few moments ago, thought that the European governments also should be increasing spending to stimulate economies. We've heard that for so long, and yet we don't see it happening.
It's been about 20 years now of austerity has been just an undercurrent everywhere, responsible government, not spending. But if you look at the debt market, it's saying spend. Every government, every developed market government,
low rates,
can borrow it at next to nothing for an indefinite period almost. So if you take that money and spend it wisely, and that's really the question, then it's going to create growth and it's going to create prosperity, and the paying back the debt shouldn't be a problem.
Michael Ingram also thought stock market investors are correct to be selling in the current economic outlook. He thinks that concerns about global economic growth, European economic growth in the future are not misplaced in the stock market. Do you agree? Do you think the sell-off we've seen this year is warranted by conditions?
Yeah, I think this is now the time to be selective. It's not so bad in economic conditions. The U.S. should be fine. If commodity exporters are going to be hurting, especially emerging market commodity exporters, but commodity importers like the United States, many others, they'll be doing fine. Financials might struggle because of the connection to commodities, but by and large, markets should do fine.
It's been good to have you here, Adam. Thank you very much.
Thanks.
That's Adam Button. He's a currency analyst at ForexLive, joining us on Queen Street today in Toronto.